Good morning and welcome back to this fine Thursday on Crypto My God. Today I want to talk about one thing, which is that the banks are crying. And my question is, when they get displaced, who will weep for the bankers? Let's get into it. A lot of this motivation is coming from a letter that was recently submitted from the American Bankers Association, the Americans for Financial Reform, the National Conference, state legislatures, the Money Transmitters Regulation Association, the National Consumer Center. Oh my God, there's so many droll and boring names on this list. It's pretty insane. But what are they doing here? They're reaching out, and what they are essentially saying is, hey, the Genius Act, it's recognizing stablecoins, and we are scared that it could potentially displace our products. Let's keep in mind the entire banking infrastructure built pre-1970s for paper-to-paper transfers, where they would actually go through each other's receipts, hand them off in parking lots. Can you believe that? Every day, these delayed settlement networks, none of this was built for the age of computers. And look, just as we updated all of society to go from hard skills to managerial skills to now AI is changing that yet again, banks have secured themselves in their dated ways through regulatory capture. Now, this memo comes out and it says a lot, but basically the summation is we are worried that the Genius Act is competitive, that it will make us compete again, and that the market will maybe say our product sucks. That is the core fear. Now, one of the things that's so amazing is that they just hammer this fearful word in there, uninsured. In fact, when I type uninsured into the find, right, I see it 11 times. That is their message. And what they are trying to take is this. The Genius Bill, as I previously have stated, says that for any stablecoin issuers, of which there are few, they must have full reserves. So $1 comes in, they can issue one stablecoin. They can only use those dollars to buy risk-off things like US Treasuries, and they cannot pass that yield. Let's break this down a couple times. One, they don't need to be insured. They are uninsured by the FDIC because they are not doing anything dangerous. The bill itself acts as the insurance. The regulation is the insurance, that if they give you a digital dollar, they must have $1 back. It must be backed by one full dollar. So if you want to redeem, you can. This is not the case in the banks, which are FDIC insured. And keep in mind, when a bank goes under, like what we saw in 2008, who gets to foot that bill but the taxpayer? So yes, these uninsured depository institutions, but the rules are very clear. They must have the money, and they can only use that money to buy T-bills. Now, the Genius Bill also added that those T-bills, that great yield, that secure risk-off yield, cannot flow back to the coin holders. And that is, again, because if it did, oh my God, if that good risk-off yield came in a new way, in a new, novel, secure, and risk-off manner, man, these banks would be totally screwed, because what is their primary function, right? It is rehypothecation. A bank does not have the regulation that says if you put $1 in a deposit, they must hold that dollar or secure that dollar. They are able to rehypothecate it, which means take the money and use it to make however many crazy bets they want to make. So one thing to understand, and this has gotten us into many financial crises, is that a bank is much more risk on. Of course, they are insured up to $250,000 because they're able to take these risks. Now, what makes me bring this up is that it is a story that's gaining increasing volume. My father shot me this New York Times article this morning, Behind Wall Street's Abrupt Flip on Crypto. And what are they talking about here? But the banks, that the banks are getting freaked out, that they're doing everything they can to secure themselves against this newfangled digital money. A dollar that, unlike your current dollar or your bank dollars, can be moved 24/7, 365, can be sent to any geography globally. It costs barely anything to actually move it from one wallet to another, and shit, it can interact with programmable money contracts. We call them smart contracts, but I'm talking about DeFi. Give this a year or two, and your savings account can be connected to a bot that you'll be able to go out and say, hey, take my savings and find risk-free ways to increase the savings. Of course, you could add risk if you want, increase the savings, but also increase your risk of a default or bankruptcy. However, that is what they are nervous about. And boy, are they shaking here. I mean, look, this headline right here in bold, stablecoins could upend the old financial order. And what is this financial order we're talking about? We're talking about banks getting your dollars, claiming them to be secure, even though many banks have gone under, leading depositors to be rather screwed, all for digitization. This is simply put, stablecoins are just digitized dollars. It's so easy, so straightforward. And yet they're trying to say, oh my God, this will disrupt the banks. If you take our capacity to rehypothecate, then oh my gosh, our AUM shrinks and our bonuses go away and all of the money that we've been playing with goes poof for this newfangled asset that is backed 1-to-1 and can interact with the wild world of digital finance. It's all quite nuts. One thing that is nice to see is to say that the first administration and Biden years were a step back. However, as banks cut off cryptocurrencies and investors from their networks amid pressures from skeptical regulators. So they do talk about Operation Chokepoint 2, which is somewhat nice, but the Genius Acts codified an untested future. Now, let's be real. This is a better outcome for consumers. The best outcome would be for the T-bill yield to be shared amongst the asset holders. But let's be honest, that would be a vastly superior bank account, and it might be a substantial threat to banks. Obviously, we can't have this flip and switch on in a single moment. That would be highly disruptive. But I mean, man, if you can't count this as a win, I don't know what is. This coalition letter, it just signals shaken in their boots. And I found this IMF working paper on the sizable role of rehypothecation in the shadow banking system, and it's pretty fascinating. I had ChatGPT summarize this so I could pull it up on screen for you, but here's the reality, right? Post 2007, 2008, after the Lehman Brothers collapse, rehypothecation was taken into a bit of control. They put some restrictions on it. Now, what that was in the United States that they could only rehypothecate up to 140% of the deposit. And there's a lot of risk that is being added that you do not get to see. Of course, the insurance is that your tax-paying dollars will bail it out if it goes bust, adding to inflation, technically making everyone's dollars worth less. But what they saw is, of course, rehypothecation following the Lehman collapse goes from $4.5 trillion industry to 2.1. Still pretty huge. However, the size of shadow banking and what they've learned is that even though it's limited to 140%, they will churn those investments into different investments. So that 140% could be used multiple times. They're sneaky bankers and they will always find a way. And unlike blockchain, where the code is open source, where you can actually verify that it only does what it says it will do, this is a system of trust that is age old. But of course, these bankers are making buku dollars off of it. Now, estimated at 4x pre-crisis, and there was decline, but the churning, the reuse of capital is happening. They're seeing that their traditional estimates underestimated the system of, again, shadow banking by greater than 50%. So a pretty interesting outcome here. And one of my favorite, most vocal people on the topic, Austin Campbell of NYU, he talks about this very much, really saying that, hey, look, they're complaining that their option is simply better. Now, option one, I take money and I buy T-bills and I have all the money on hand if people want it back. This is the stablecoins. And this is what they're saying is uninsured and sketchy and shouldn't be permitted, or at least should be wink, wink, side-eyed. Now, option two, I take the money, I lever up massively, lend to a bunch of people in an illiquid fashion, don't have enough money to give all the money back if people ask, and I pray. That is the current banking system as it stands. So here's my call to action for everybody. I started this channel because seeing the news present crypto to the public, it is always putting a sketchy bent on it. Obviously, with Trump coins, with meme coins, with grifters, with social media influencers, crypto has a terrible image, and that pisses me off because this is about freedom, this is about money, this is about sovereignty, and this is also about updating a system that frankly didn't work. Whether you're an anti-fiat Bitcoin maxi, either way, no matter how you look at this, blockchain provides a better financial structure. Now, not only when we get back to the attack of this uninsured deposit institution, not only do we not have to worry about this because the Genius Bill says there has to be one-for-one backing, but we're entering a world of don't trust, verify, where these smart contracts do exactly what they say they need to do. This is why Elizabeth Warren tried to take down the crypto industry by forcing DeFi intermediaries, these smart contracts, to become licensed broker-dealers, money transmitters, basically things that computer code cannot go out and gain themselves, when in reality, we don't need these things. I'm sorry. And that is what it comes down to, is that the code is better because the code is clear, it's available for everyone to see, to verify, and it does and performs exactly the function that it says it will. This is a much better system than giving your money over to the bank and letting them run willy-nilly with it. So all sorts of fascinating things coming out, but there's no doubt that the banks are going to get louder and louder around stablecoins as we see the continued proliferation of L1s from Stripe, from Circle, from Tether, of course, Plasma Chain, but they are beginning to shake in their boots. And of course, first they laugh at you, then they fight you, then you win. And we are very much in the winning phase. But my oh my, are you going to see more stories funded by the people who get giant bonuses based off this rehypothecation play and things like this sick ass Benjamin Franklin graphic, which is actually pretty cool. And I might just want it as an NFT. With that being said, enjoy the bull run. I know it's dipping today, so that's exactly why we don't overlever and lean too far into any narrative. Stay safe out there, don't get liquidated, and I will see you tomorrow.